This is why you need to pay attention to gold prices right now. So, here's the deal. Gold prices have been climbing steadily in 2024, hitting around $2,500 per ounce. Why? First off, the Federal Reserve's expected interest rate cuts are making gold more attractive. Lower rates mean lower yields on things like bonds, so investors flock to gold. Next up, geopolitical tensions. Conflicts, especially in the Middle East, have people turning to gold as a safe haven. And don't forget, central banks, especially in places like China, are stacking up on gold reserves, which pushes prices up even more. Now, what's the forecast? Some experts say we could see prices hit $2,700 by year's end, and maybe even $2,900 by early 2025. Why? Ongoing global uncertainties and demand are the big drivers. Gold prices have been climbing in 2024 due to several key factors. One major driver has been the anticipation of Federal Reserve interest rate cuts, as lower rates typically make gold more attractive by reducing yields on competing assets like bonds. Additionally, geopolitical tensions, such as those in the Middle East, have fueled demand for gold as a safe haven asset. Central banks, particularly in emerging markets like China, have been significantly increasing their gold reserves, which further supports the rising prices. Gold price forecast JP Morgan, vertical bar official website. Currently, gold is trading around $2,500 per ounce and is expected to reach up to $2,700 by the end of 2024. Some projections even suggest it could hit $2,900 by early 2025, as both global economic uncertainties and demand from central banks continue to influence the markets.com, markets.businessinsider.com. Historically, gold prices have shown significant fluctuations tied to economic cycles, inflation, and geopolitical events. For example, gold hit an all-time high in 2011 during the European debt crisis, and again in 2020 during the COVID-19 pandemic. In recent years, gold has been closely linked to monetary policies and market fears, including inflation and potential recessions, markets.businessinsider.com. In the near future, continued geopolitical instability and monetary policy changes, particularly in the US, will likely keep gold prices on an upward trajectory, with potential short-term volatility along the way. JP Morgan vertical bar official website. Gold prices rise due to a combination of economic, geopolitical, and financial factors. 1. Inflation and currency. Devaluation. When inflation is high or a currency, especially the US dollar, weakens, investors flock to gold as a store of value. Gold maintains its purchasing power over time, making it an attractive hedge against inflation. Gold price forecast, JP Morgan, vertical bar official website. 1. Geopolitical uncertainty. During periods of global conflict or political instability, gold often rises in value as it is viewed as a safe haven asset. Recent geopolitical tensions, such as conflicts in the Middle East, have driven investors to seek the relative safety of gold. JP Morgan vertical bar official website markets.businessinsider.com. 1. Interest rates. Lower interest rates reduce the opportunity cost of holding non-yielding assets like gold. When central banks, particularly the US Federal Reserve, signal or implement rate cuts, gold tends to rise as bond yields fall and the appeal of gold increases. Gold price forecast, JP Morgan, vertical bar official website. 1. Central bank demand. Central banks, particularly in emerging markets, have been increasing their gold reserves as part of their efforts to diversify away from the US dollar. This heightened demand can drive prices higher. Markets.businessinsider.com. 2. Market volatility and recession fears. Gold acts as a hedge against market volatility and economic downturns. When fears of a recession or financial instability grow, as has been the case in 2024, investors turn to gold to protect their portfolios. Markets.com. These factors together create an environment that pushes gold prices upward, particularly during times of uncertainty. In addition to the key drivers I mentioned earlier, several more factors contribute to gold price increases. 3. US dollar weakness. Since gold is priced in US dollars, a weaker dollar makes gold cheaper for foreign investors, boosting demand and driving prices higher. When the dollar declines in value relative to other currencies, gold tends to rise. Gold price forecast markets.com. 1. Supply and demand imbalances. The supply of new gold is limited by mining output, which can fluctuate based on production difficulties or geopolitical issues in gold-producing regions. Meanwhile, demand can surge due to investor activity, central bank purchases, or increased consumer demand, for example in jewelry markets, particularly in India and China. This imbalance between supply and demand can push prices upward. Markets.businessinsider.com. 2. Monetary policies and quantitative easing, QE. During economic downturns, central banks may implement QE, which floods the economy with liquidity by buying government bonds and other securities. This policy can lead to concerns about future inflation, prompting investors to buy gold as a hedge. Additionally, QE often leads to lower bond yields, making gold a more attractive alternative. J.P. Morgan Vertical Bar official website markets.businessinsider.com. 1. Market speculation. Investors sometimes speculate on the price of gold, expecting it to rise during times of financial market volatility or downturns. This speculation can drive prices up even further, creating feedback loops of rising prices and higher investor interest. Markets.com. 2. De-Dollarization and reserve diversification. Some countries and central banks are increasingly diversifying their reserves away from US dollar assets, often into gold. For example, nations like China and Russia have increased their gold reserves as part of a broader strategy to reduce reliance on the dollar, contributing to a higher global demand for gold. Markets. BusinessInsider.com. These additional dynamics combine with previously mentioned factors to create a complex interplay that impacts gold prices. To dive deeper into what drives gold prices upward, let's explore additional factors beyond economic and geopolitical influences. 3. Gold's role as a hedge against market risk. Gold is often used as insurance against risk in financial markets. When stock markets face significant volatility or downturns, gold typically becomes more attractive due to its historical stability. Investors look to gold as a hedge against the uncertainties tied to equities, bonds, and other financial instruments. J.P. Morgan Vertical Bar. Official website markets.businessinsider.com. 1. Global economic policies. Economic policies in major countries, particularly in relation to trade and fiscal deficits, influence gold prices. For example, concerns over growing fiscal deficits in the US or Europe may reduce confidence in fiat currencies, encouraging investors to turn to gold as a store of value. Markets.com. 2. ETF and investment fund flows. Exchange-traded funds, ETFs, and other gold investment vehicles enable large-scale purchases of gold by institutional and retail investors. As more funds flow into these investment vehicles during times of economic stress or anticipation of rising prices, demand for physical gold rises, lifting prices further. J.P. Morgan Vertical Bar, official website. 3. Gold production costs. The cost of mining gold has increased due to technological, environmental, and political challenges in key mining regions. When the cost to produce gold rises, mining companies tend to produce less, which restricts the supply of gold in the market, driving up prices. Markets.businessinsider.com. 4. Currency market fluctuations. Since gold is often seen as a global currency, its value moves inversely to the performance of other currencies, especially the US dollar. When there are fluctuations or instability in currency markets, gold often benefits as investors move their funds to what they consider a more stable store of value. J.P. Morgan Vertical Bar. Official website markets.businessinsider.com. 1. Cultural and seasonal demand. In countries like India and China, demand for gold surges during specific times of the year due to cultural traditions, weddings, and festivals. India is the second largest consumer of gold, and spikes in demand during major festivals like Diwali can temporarily lift global gold prices. Markets.businessinsider.com. 2. Environmental and political risks in mining. Political instability in key gold-producing countries, environmental regulations, or labor strikes can affect gold mining output, limiting supply. A constrained supply, while demand remains high, pushes prices higher. Markets.com. Markets.businessinsider.com. This range of economic, cultural, and financial factors creates a dynamic environment where gold prices can fluctuate based on a complex mix of global events, investor sentiment, and market forces. Yes, other metals, particularly silver, platinum, and palladium, are also expected to rise in the near future, driven by several factors similar to those affecting gold, as well as industry-specific dynamics. 1. Silver, often referred to as poor man's gold. Silver tends to rise alongside gold due to its dual role as both a precious metal and an industrial commodity. Like gold, silver benefits from economic uncertainty and inflation hedging. However, silver's industrial demand, especially for use in electronics, solar panels, and electric vehicles, also plays a major role. Analysts expect silver prices to increase due to rising demand in green energy technologies. Projections suggest silver may rise toward $30 per ounce by 2025 gold price forecast. J.P. Morgan Vertical Bar. Official website. 1. Platinum. Platinum is primarily used in industrial applications, including automotive catalytic converters, hydrogen fuel cells, and jewelry. The push towards clean energy, particularly hydrogen fuel cells, has boosted demand for platinum. However, supply issues from key producing countries like South Africa have created constraints which could drive prices upward. Platinum prices are expected to continue rising as the demand for hydrogen technology increases. Markets.com. J.P. Morgan Vertical Bar official website. 1. Palladium. Palladium has become increasingly valuable due to its critical use in catalytic converters, which reduce harmful emissions in gasoline engines. With tightening emissions standards globally, demand for palladium has surged. However, like platinum, it suffers from supply shortages. Russia, a major producer of palladium, faces geopolitical sanctions, reducing global supply, which could push prices even higher. Markets.com. 2. Copper. Copper is essential in construction, electrical wiring, and renewable energy projects. The transition to green energy, particularly electric vehicles and renewable power grids, has driven a strong demand for copper. Analysts forecast that copper prices will rise in the long term due to these increasing industrial applications, though short-term fluctuations may occur. Markets.businessinsider.com. In summary, rising demand driven by technological shifts like green energy and electric vehicles, along with supply constraints and geopolitical risks, is likely to push prices of several metals higher in the near future. Keep an eye on industrial metals like silver, platinum, palladium, and copper as they are poised for growth. Historically, gold shines during economic cycles, inflation spikes, and geopolitical events. Remember 2011's debt crisis or the 2020 pandemic? Gold was the go-to. So keep an eye on those rates, geopolitical news, and central bank moves. Gold's rise isn't just a flash in the pan, it's a response to a complex web of economic forces. Stay savvy, folks. Don't miss a notification. Subscribe now. Thank you.